Hello, Dividend King subscribers. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And for today's FastGraph Friday Analyze Out Loud video, I'm going to update ViacomCBS. I was asked by a subscriber to do that, and what they were referring to, I believe, because I didn't get that for sure, is an article that I published where I actually covered 4 companies, of which ViacomCBS was only one. And this is that video from that article that was published back in February of this year. And this is what Viacom looked like. I want you to notice, earnings expectations for 2020 were 538, 612, and 620. And the stock looked extremely undervalued. So that's what the company looked like when I actually posted the article and did the video. And these are just a couple of comments I made on that video.
And, the family, and of course he's older, in his 90s, I guess. And there's a lot of concern about the fact that, the Redstone family owns such a large portion of this. They do have Class B shares, which are non-voting shares. So there's some issues there. But it's a very, very powerful media company.
So that, gives you some insight to what I was thinking back then. I did talk about the Redstone family owning it. Now, Sumner has died since then at 97 years old, bless his heart. His daughter has taken over the company. So let's now fast forward and look at what Viacom looks at today. I still have a lot of the same feelings as I indicated in the written portion of this article about this company, but I'm going to make a couple of points here. The stock is too cheap to ignore. When I published that article, that was in February 26th of 2020. Well, this is 2 days later. It's almost identical price. You can see that the stock initially dropped precipitously from the time, I wrote the article by the end of March 31st. So 1 month later, the stock is down 43% when I was actually publishing that first, argument that it was too cheap to ignore. Now, this was obviously COVID, and this was clearly the flash crash. But since that time, since it bottomed out at $10.10, the stock, as I indicated also in the article, has increased significantly, over 100% from its bottom, 127%, including dividends from its bottom, where the price went from a low of, as of this report, of March 31st of $14.01 to a price of $31.29. So that was a big recovery. As I pointed out in the article, from the standpoint of when I wrote the original article, which was on, February 26th, I've got February 28th here because I only have month-end closing prices. The stock as of yesterday's close is up about 29.8%, and I indicated that in the article. So once again, finding perfect tops or bottoms is not possible. But let's look at this company from the valuation perspective where it stands today. Earnings, instead of being over $5, are expected to come in at $4.15. They just did announce their earnings today, and they did beat, and they actually have almost hit their goal for new subscribers to their streaming service, and a lot of positive things in it, but yet the stock is down 3% the last time I looked today. Nevertheless, we have had a nice recovery, but the stock still sits significantly below its earnings justified level. Now, before I leave this graph, this is operating earnings. I want to make a couple of points here. This company, frankly, is not my cup of tea. They started paying a dividend in 2003. I'm only writing about it, by the way, because it's so inexpensive. It's obviously very cyclical. They had actually negative earnings growth through the recession of 2001. And then, earnings through the Great Recession fell precipitously, 14% in 08, 67% in 09, but then they recovered dramatically. Now, the company is quite a bit different. Remember, in 2019, December of 2019, they merged with CBS, so this is a kind of a new company going forward, but it's still a very cyclical industry, and I talked about some of the things that concern me. Competition from Netflix and Hulu and YouTube and a lot of other places. It's a very dynamic industry, and I did talk about all the other properties they have, the film, just goes CBS, of course, with all of their properties, the NCIS series, and a lot of the, exciting things about that. So the company does have some validity. It's only BBB rated, which is investment grade, but just barely. It does have a lot of debt, and I'm going to talk about their financial statement here in a moment. But this stock is just a little too cyclical for my taste. Also, their dividend record. I look for that consistent year after year dividend aristocrat champion, challenger contender type company. Now, if I shorten this graph, for a shorter period of time, the company has increased their dividend at about 15% a year since 2011, but they did freeze it in 2017 and 18. So, it's not necessarily as predictable a dividend growth stock as I personally like, but yet it'd be hard-pressed to say because of that one freeze, it's not a dividend growth stock. And again, it's a new company today. But what's really interesting, I want to go into the forecasting graph here a little bit. And the first thing I'm doing here, I'm looking at the normal PE ratio, which is the 5-year normal PE ratio recently has been 12.89. So given that, if this stock would just go to a 12 PE from its current blended PE of 731, by year end next year, if assuming the estimates came in correctly, you'd have an annualized rate of return of just under 77%. That's pretty darn attractive. That's just simply reversion to the mean. 11% growth, but most of this return is coming from, PE expansion, going from a 7 multiple to a 12 or 13 multiple. And that's kind of a conservative multiple for this company. Now, next year, we're only looking for 7% growth. And then there's 8 analysts think this company is going to have negative growth. If I look at long-term growth, it's actually considered to be negative by 4 analysts only reporting, but they're actually saying, minus 1% growth. And that, I think, has to do with what I mentioned about the streaming, services attacking them or competing with them, etc. So it's a little bit iffy. I'd like to see better growth than that. Now, from a positive point of view, it is very, very inexpensive. I did point this out in the article. I want you to notice that their earnings estimates went from, over $5 a share, $5.38 if I recall from memory, was expected when I did the article in February. Now, 6 months ago it was $3.73. Then 3 months ago it was $4.09. The most recent estimate was $4.13, and now the estimate's up a couple cents over that at $4.15. So analysts have been getting more confident. Now they've had some positives of the pandemic, and they've also had some negatives hitting them. But the reality of it is the company is certainly trading at a valuation that's cheap enough. Now, it is a dividend growth stock, so I do want to move on from here and get off of earnings for a while. And I want to look at I do want to look at a couple other earnings. I want to look at owners' earnings, which is one of Warren Buffett's favorites. And, this also gives me kind of a shaky picture. Owners' earnings drop precipitously, but they are expected to rise and then drop again. From a forecasting point of view, owners' earnings look very good for the next 2 years. And then down. As I always say, valuation is a puzzle. I like to look at all these different metrics. I think looking at GAAP earnings, considering the fact that the company's had, several mergers and acquisitions, including the recent CVS merger, there's a lot of accounting convention, you're going to see in their earnings where there's been a lot of, adjustments made, non-cash charges and things like that. And then if I go on and move on to operating cash flow, where what I'm really trying to look at here is I want to look at dividend coverage. And, we have it ranked relatively low considering, a 3 out of 5 for dividend safety. Others have it ranked as a C, A through F being the grading site. So dividend safety is somewhat suspect, and I'll get into a little bit more of that in a moment. But the reality of it is their operating cash flow does cover their dividend, and free cash flow, which is very close, almost kissing cousin to owner's earnings, also shows that the free cash flow is covering the dividend and always has covered the dividend. So, I don't think the dividend's in jeopardy of being eliminated, but there were times when the free cash flow dropped precipitously where they did cut the dividend. They slashed the dividend from $1.06 to 20 cents from 08 to 09. Then they kept it at 20 cents for another year, and then they started raising it again, and it's grown rather nicely. And right now we got a dividend streak of 1 year because they did freeze the dividend in 17 and 18, again at the 72 cent level. So, it's not horrible, but it's not my cup of tea as far as that goes. So I want to now turn to the company's balance sheet because, as I mentioned in the article, I have some concerns about the balance sheet. The company does have a lot of debt, and their cash position relative to that debt is rather anemic. In 2019, they ended up with about $632 million in cash. Now, when I upgrade that through the June quarter, I do discover that the company's cash position has improved quite dramatically. It went from $580 million at the end of March to $2.28 billion by the June quarter. I haven't gone through their financials yet to see what their cash looks like now. But, bottom line is, this is a very interesting company from a valuation perspective. From a standpoint of, free cash flow, it would still look attractively valued, but not necessarily very cheap. When I go to the normal adjusted operating earnings, what I really see here is a company that is quasi-cyclical, certainly. It does have a long-term growth rate, but as I shorten this time frame, I want you to know that the growth rate has been slowing quite a bit. If I shorten it a little more, went from 8% to 5.8%. If I look at it going forward, which is always where I believe you should make your decision, growth actually is expected to average negative. It's going to be, minus 17% this year, which is only obviously a month or so, a couple months away. Hopefully 25 analysts expect 11% the next year, and then it drops down to 20 analysts think 7%. And then we have 8 analysts think they're going to have a drop in earnings for 2023. You can check other sources of estimates for, additional data. The longer term trend line bothers me. 4 analysts think this company is going to have long-term negative growth. Now, I can combine the short-term growth forecast that I've been showing you with this long-term growth forecast, and we end up with a negative number. So, this would all be about recovery and reverting to the mean and moving back into a, PE ratio in the 12 or 13 range, which could make it a very attractive investment long term, but that's strictly almost a speculation. I don't see a lot of growth. Again, I'm not real happy with, some of the things that are going on in this company. I don't like the balance sheet. One thing I didn't mention when I was covering the balance sheet, actually, let's go to that real quickly because I think it's real important. When you look at the company from a standpoint of assets, of total assets, you see some pretty shaky numbers here. You see the assets went down dramatically, and of course this is the merger, where the assets have increased dramatically, but once again, there's a lot of goodwill and intangibles on the balance sheet that I think are, again, suspect, so I don't consider the quality of this company's assets to be real strong. So all in all, it's a very attractive stock. If you're looking for a speculation and something that could make a great deal of money in the next couple of years, you might want to take a look. It's not my cup of tea, but that doesn't mean it shouldn't be your cup of tea. What I wanted to give you here is like the old Joe Friday on the Dragnet TV series years ago used to say, just the facts, ma'am, nothing but the facts. My job here is to give you the facts and help you and let you make your own decisions. It's certainly too cheap to ignore, but it's not necessarily, the type of stock every investor might want to gravitate to. I hope you enjoyed this. If you like this video, don't forget to subscribe to my YouTube channel. I look forward to talking to you guys again next week. Everyone have a great weekend and stay safe out there. Thanks for watching.